All right, we are now live.
Countdown to noon webinar.
Yes, yeah, I can see there's a few people still waiting to join, so we'll just give it a few minutes till 12 o'clock, maybe even 12:01, and then we'll get started here.
And earlier today, one of our colleagues noticed you had a picture off your shoulder, and two people were wearing masks. What?
Yeah.
You don't put people wearing a mask on your mantle, but tell us that one.
Yeah, so in the fall, my mom and I went wedding dress shopping. And so that's a photo of my mom and I. Here, I'll grab it. So this is my mom and I. Kleinfeld's in the background there. And it was right before actually the numbers significantly increased. So we felt like there was maybe a window where we could quickly try and find a dress just to have one for the wedding date that is still pending.
There we go. Well, it was a several day event, and I was lucky enough to be able to join on the final day.
Yeah.
In the excitement. So
yeah, my sister joined. It was fun.
Yeah.
Kelly, yeah.
Yes.
Yeah. And Kelly, I think she was saying she was doing a mediation panel or something today. So that's interesting. She's a family lawyer.
Great. Interesting.
All right, well, we are at 12 o'clock right now, so we'll just give it maybe another minute here before we dive into the presentation, because I can see that there's a few people still logging on. So we'll give it another minute.
Excellent. Beautiful sunny day in Oakville. And
it is beautiful out. It's not as cold as it has been. I found it quite mild this morning when I was walking the dogs, so it was nice.
No, afternoon in Oakville is going to include a walk, so nice to have it.
That's awesome. That's good. Well, hopefully wherever you guys are who are watching right now, it is sunny like it is for both Peter and I, and hopefully we can get outside. It's always one of my favorite parts of the day.
Thank you, Dave, for your kind note I just saw on the bottom of the screen. Hope all is well.
Okay, well, we're at 12:01, so let's get started here because today's presentation it's short. It's going to go by quickly, I think, but it's only 20 minutes. So welcome to Grow Your Wealth presentation. I'm here with my dad and colleague, Peter Watson, and myself, Jennifer Watson. Today's conversation is for Canadians who are getting employment income. We are going to have a presentation later in the spring for anyone that is either self-employed or has their own company. And as always, please, if you're watching this webinar, please reach out to have a conversation with myself. We're going to post a link in the chat box shortly. And that is a link to actually view my calendar. So you can book a time with me to have a conversation, whether you're an existing client, prospective client, or someone that just has a question. Love to hear from you and talk to you. So please feel free to reach out to us. All right, let's dive in.
Well, we're going to be discussing some investment ideas, but the focus today is on tax planning. We want to offer some tax strategies that people might want to consider. Perhaps you're already doing it, that will help your circumstances. And wanted to make something clear at the beginning. What might be a great idea for somebody might not be a great idea for you. So we'll talk about some ideas, but before anything is acted upon, make sure that we have that conversation with you just to make sure that it's applicable in your circumstances. And I guess I'll start, Jennifer, if I can ask you a question. If we were having a conversation with a client at the beginning of the year, January, February, about tax planning issues, how might those questions that you'd want to ask the client, how might those questions start?
Yeah, so first we really want to figure out what is your income for 2020? What's your expected income for 2021 and 2022? If you have a spouse, we also want to know the same information for them as well. That really helps us decide, what tax bracket you're in for the current tax year, and what tax bracket you're likely to be in the future. That information will really help us then with how much, if at all, should you be contributing into an RSP, and how much now versus how much in a year or in 2 years from now should you be contributing.
Okay, well, I'd like to perhaps add a point here, and this is going to be an oversimplification on purpose, just to sort of present the concept, not the details. When people look at saving taxes, they might get it confused on how advantaged it actually is in their circumstances. For example, let's say your income is $1 and you are in a 40% tax bracket. You therefore will pay 40 cents to the government at the end of the year. Fine, that's understood. But your average tax rate doesn't fairly represent what's going on. What you're doing is some of your income, you're having a 30% tax. Then as your income increases, you're perhaps up to 40% tax. And again, this is an oversimplification. And then finally, you're at a 50% tax rate. So if you can save $1 in taxes, if you reduce your income by $1, are you going to save 40 cents in tax? No, you're going to save 50 cents because in Canada, our tax rate is progressive. So if you reduce the top bit of income, you're reducing your top rate. So the ideas we're discussing today are going to be more advantageous than they might otherwise appear. So Jennifer, to start off the tax conversation, what typically would people do to have tax planning, tax sheltering on a yearly basis?
Yeah, so the most common and most likely scenario that makes sense would be an RSP contribution. Again, I mentioned at the beginning that it does depend on your taxable income. And like Peter just addressed, we're looking at the marginal tax rate here. So that's the first consideration. But RSP is really one of the probably better routes to go when you're looking at that dollar that you can save every year and where should that dollar go to get the most benefit. You know, I understand we have a lot of competing priorities. Likely you're in all of these competing priorities or some of them, but it's mortgage, RESP, so planning for your children's education, RSP contributions, and maybe even other competing priorities. So it can definitely be very challenging to know how much money we should put somewhere and what's going to get the most benefit. So when we're looking at then the RSP contribution, we want to make sure that, you know, one consideration is looking at our spouses' accounts is we want to try and keep our pension income relatively equal with our spouse. So what this means is any pensions you might have at work or with a previous employer, plus any RSP accounts, try and keep them relatively equal. The reason for that is that when we file our taxes every year, we want to pension income split, which is something that now we're allowed to do. It hasn't always been the case, and we're not sure if it's always going to be the case moving forward. So if we keep these accounts relatively equal, then it keeps the time when we start to withdraw the money from these pension accounts relatively equal on our tax return. So let me just back up and say a little bit more about when I said pension income splitting, what that means. So let's say one spouse has a higher pension right now, that would go pushing them into the highest tax bracket. Well, right now we can actually split that pension income into the other spouse, which reduces the taxable income. So from a net family perspective, we're actually ahead if we can do this pension splitting. Most often than not, that is. So we want to try and keep those accounts relatively equal. Now, let's say though that we have, you know, spouse A and spouse B. Well, spouse A, let's say, makes more money than spouse B, but spouse B doesn't have as much pension money right now in their name. Well, what we can do actually is we would then use a spousal RSP account. So we would have spouse A contribute, that uses their RSP contribution room and contributes into spouse B's spousal RSP account. That gives the spouse A with the higher marginal tax bracket the benefit, again, netting family ahead, but puts the money in spouse B's name just to have our options open for us for tax planning for later years down the road.
So let's say one spouse has a higher income and the other spouse perhaps works part-time, the higher income spouse can make the contribution, take the deduction at the higher rate, but yet then move that over to the lower income spouse, which will help down the road. That's so basically the journey of an RSP is you make tax deductible contributions. While the money is within your RSP, it grows and compounds tax-free. And eventually down the road, decades down the road, during retirement, when your income likely is at a reduced rate, you take that money out of your RRIF and it is, again, taxed at a lower rate. So typically, most clients would want to think that they will not convert their RSP to their RRIF at 71, because as many of you might know, RSPs have to stop at a certain point. So in the year that you turn 71, by the end of the year, end of the last day of the year, you have to have converted to a RRIF. But Jennifer, in the past, we've had a couple of examples, actually quite a number of examples, where we have started the RRIF contributions, the RRIF conversion prior to the age 71. Why would we have done that?
Yeah, so for two reasons. For sure, most likely, the most common reason would be is we want to try and get 2,000 of pension income is tax-free. So if we can have 2,000 for both spouses coming out starting at 65 onwards, that's a great way of being able to take out money from that type of account in a more tax advantageous way. And then if you don't need the money, rediverting it into another account to continue to be invested and grow for the future. Another reason why we might want to do that is, let's say you're not working or you don't have higher income, we might want to actually create a little bit of income, pay a little bit of tax with the expectation then that down the road we would be reducing that overall tax bracket. So it becomes a bit of a balancing act. It becomes a balancing act based on what's going on in your life right now, how much spending do you need to spend, how much money do you want to spend, and what other income you have coming in.
Jennifer, that's an interesting point. I've had many conversations with clients, and it's sort of interesting to explain it this way, but during your let's say you're going to retire at age 65. Of course, you have good income and you pay a lot of taxes. But then from 65 to 71, you've got a tax window, a tax holiday, because your income has stopped, so you're not paying tax on income. Your RSP hasn't been converted, or the bulk of it hasn't been converted to a RRIF, so you're not getting RRIF income that is taxable. So you've got a period from retirement, whatever that might be, and age 71. So rather than keep all of your RSP RRIF until the 70s to withdraw and then have that included as taxable income, start, as Jennifer mentioned, start bringing that out. Now we have to go through the tax, your tax return to make sure we know the right strategy amounts. But you're taking out money while it's at a zero or a low tax rate to prevent having to pay taxes just a couple of years down the road. So there's lots of things that we can be talking to you about. It really just depends on your circumstances.
Mm-hmm. And, when we're talking about your tax bracket in 2020 versus 2021, 2022, maybe a more extreme scenario, but one way of kind of explaining a little bit more about how the RSP limits work would be to say that every year we work and we have employment income, as you probably know, we have 18% of that gets to go towards an RSP contribution, up to a maximum. Maximum right now is around 27,000. And what happens is if we don't maximize our RSP contribution limit every year, which we might not, and it might not make sense for us to do it every year. Earlier stages of life, we have probably money going towards saving for that first home, mortgages. And so we do probably accumulate a little bit of back contribution room in kind of the first phase of our working life. Now, if let's say we know in 2021, our tax return is going to be significantly less for whatever reason, maybe you're starting your new company, so your taxable income is going to be expected to be less. That year of 2020 then, so this current tax year, we want to maybe use up all that back contribution room. So maybe let's say we have 100,000 of back RSP contribution room. You can actually make an RSP contribution of that full amount and claim it on the tax return that year and get this big refund. Because it's kind of our last expected year to have high income, it's definitely something we want to maximize and take advantage of, again, depending on your overall circumstances. But that's kind of sometimes the scenario when you actually might even want to borrow a little bit for the purposes of investing. Because if you borrow it today, well, we're in February, make your Rsp contribution. Come April, we file our taxes. Maybe we want to do it a little bit early to get that refund as fast as possible back to pay off that loan that was done. So there's knowing kind of more than just what's happening in our current tax year, knowing what's expected to happen in the future can really, I think, enhance the overall tax planning that we're able to do.
And then add to those ideas that you've already mentioned, that we've already discussed, is of course the tax-free savings account. And to put the tax-free in proper context for Canada, we're a very caring society. We have better safety nets versus some other countries, and consequently our tax rates are a little higher than some other countries. So anytime the government says, okay, for this part of your portfolio, you can have tax-free, you absolutely want to maximize that. For example, if you had the option of buying a GIC in your tax-free savings account, or investing in an equity mutual fund that has the potential of increasing significantly over a good number of years, I don't think you want the GIC. And the reason being is the interest rates are at absolutely rock bottom historic lows. So GICs and other fixed income vehicles don't really pay that high a return. So there's really not a lot to protect at the end of the year. In your tax-free savings account, you want to, and again, depends on your circumstances, but you want to have your best investment. What is likely going to give you the best return over time? That is likely what you're going to want to have in your tax-free savings account.
Mm-hmm. Yeah, that's a really good point. And so then I guess there's two more quick comments around RSP. And then I think it'd be really great to, we've mentioned a few times, if you can only save that dollar and where that dollar should go. So maybe then it'll be a really good time to talk about, how do we determine how much money we should be saving today for the future, and where's that balance fall into place? So before we get to that point, we'll just mention, if you have a work RSP matching program, I think that's awesome then that you've been given this as an employee benefit. Make sure, regardless of your tax bracket, you're maximizing what your company is going to give you. So if they're going to give you 5% of your contributions, 5% of your salary into contributions, and they're going to match that, make sure you match that. Anything above that, if you still have RSP room above that, for our clients, that's typically when we'll manage that portion of the money. But definitely maximize what your company is going to give you. I think it's a huge benefit. And then just take a look at what your employee plan is actually being invested in. That's another thing that an advisor can help you with. They can take a look and make sure that you're in the right risk profile that suits you, and that we're complementing what we're doing with the rest of your portfolio. The other thing is stock options. If you have stock options at your company, once they vest, it's typically a good time for us to manage it to diversify out. So sell the stock options that have vested at that point in time, diversify out. Of course, other factors come into play.
Yeah, we've had conversations with people, let's say the vesting period is up and now we have the option, the client has the option of cashing in. Sometimes there might be political implications, sort of, the first day you get a chance to access your money out of the company stock. What are the political implications for your organization? But from and so those are very important. And from our perspective, we are very strong believers in diversification. So if you've got a job, a salary tied up in one company, perhaps other pension money not vested yet tied up in one company, we do like diversification. So all things being equal, it would be, we think, to your advantage to diversify that in other companies around the world. So Jennifer, let's in the time remaining, can you just touch a little bit on what people might want to do if they're anticipating their children will go on to post-secondary education?
For sure. Yeah. So, RESPs is basically the first step when planning for your children's education. An RESP is something that if you have a child, you have to contribute into it, is our personal opinion. The government's going to give you 20% of your contributions up to there's certain limits. So definitely make sure you're maximizing that. That's a huge return. But I understand, again, it's always that balancing act. We are going to have future webinars about RESP planning and education planning in general, as well as we have an ebook coming out this summer that will be on our website. And if you get our newsletter, we'll be emailing it out to you as well. So that is, that's one of the competing priorities. So Peter, do you mind quickly talking about how we figure out that balance between spending now versus saving for the future?
Love to do that, Jennifer. Thank you. And that's one of my favorite topics. Most people want to, down the road, depending on their age, down the road, prepare for a happy, enjoyable retirement that they get to live the lifestyle that they've dreamt of. And so that means they have to accumulate a nest egg. So there's really two ways to decide how much you're going to save. One is to say, okay, I'm making $1 after expenses and lifestyle. We have this many dollars left to save. That can be one option. The other option is part of the planning process, and clients have been through this, and you go through it on an annual basis. We will look at what your nest egg has to be to give you the desired lifestyle, and then determine with the help of the software and show you how much you have to save every year and how much of a return, how much will that money grow over time between now and retirement. So it's a combination of what you can do and what you have to do. Now, so the question I'd like to ask, what happens if, and I know we're getting close on time, but what happens if for whatever reason you don't save as much last year as you were hoping to? And also what happens if the investment returns were less than you had hoped? Well, regardless of what happened in the previous year, every year we'll redo those numbers. So, as I like to say, quite often life happens. So we need to every year redo the numbers. That's our quality control assurance that your targeted objectives through your years and decades of working with us will be met. Every year we redo the arithmetic. So Jennifer, that's that point I wanted to make sure we put that in.
Yeah, for sure. And that's a really good point. So just to kind of wrap us up now, because I know we're just approaching, we've just hit our 20-minute mark, and we promised you that this would be short, even though Peter and I could talk about this for a very long time. There's some other considerations that you likely have that are really important to note. So we'll just kind of quickly go through those. And then we have a lot of webinars coming up, like we mentioned. So please make sure you sign up for our newsletters to get those invitations. Our newsletters, you can email either one of us, or on our website, the homepage, there's a link to sign up for newsletters. Great ways of building wealth is making sure you're paying yourself first. Having an automatic contribution tied with your paycheck to go into an investment account, out of sight, out of mind, put it in something that's invested for the long term. Really smart idea. Bonuses, tax refunds. This is maybe a boring answer, but invest them. They're not money that you are living off of on a daily basis. So put it towards something that's going to benefit you in the future. Mortgage paying down, there is a balance there. Mortgage rates are really low right now. So definitely figure out what's that balance for you versus comfort level. It depends on your employment stability and your spouse's employment stability. What's that safety net look like for you? Paying down your mortgage as fast as possible, like it used to be when the mortgage rates were really high, is not always necessarily the best solution. So that's definitely worth a conversation. And making sure you always have access to capital. While you're working, it's typically easier to have access to capital. So to have a home equity line of credit, have that before going into retirement. Just opens up flexibilities. It's not to be used, it's just to be used if there's ever a need for it. So lots of conversations can happen around that. And what to do with your adult parents, how to help them, make sure that they have a team that they're working with, make sure that they've looked at their own cash flow projections to ensure that they have that quality of life throughout all years of life. And bring in professional help if you need to. Being in the sandwich generation, as probably a lot of listeners are, it's a lot of competing priorities, and You might even have to be the executor at one point in time, and that's a huge responsibility. So we'll try and keep providing as many resources to educate you about all these different topics, but also we're always here to answer any questions that you have about any of the things to deal with wealth management for yourself or for your family. And if you're going to inherit money, that's amazing. That's great. That's lucky. And, make use of that money. Make sure you put it in the right place that's going to benefit your family the most. So lots more conversations to come, but we really appreciate you listening today. Really appreciate your time and look forward to speaking to you further in some follow-up conversations. So please sign up for a conversation with myself and reach out to Peter with any questions as well.
Yeah, nice speaking to you, everybody, today. Thanks for joining.
Thanks so much.